Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. In today's video, I'm going to be covering the high points for my March 24th energy update. As I'm sure you're aware, the coronavirus pandemic has caused markets throughout the world to collapse. And this includes commodity markets. Even markets such as gold and silver, which are normally flight to quality markets, did collapse earlier this week. This takes place when there's great fear and uncertainty, and traders and investors will simply get out of all markets and move into cash. I believe this is what has taken place in natural gas. Before declining to $1.52, natural gas prices were already the lowest they had been since it began trading in 1990. But I've learned over the years the best opportunities often occur when a commodity's supply-demand fundamentals don't justify it declining in sympathy with other markets. It is also important to note that since 2000, the three previous times natural gas was below $2, it always was followed by much higher prices. Therefore, the empirical evidence supports much higher prices by the end of 2020 and higher pricing on average over the next 3 years. And as I explained in my March 2nd energy update, probably the best example is what took place in 2012. This was the second of the three occurrences when pricing dropped below $2. In that case, we had just finished the warmest winter in over 100 years. The supplies of natural gas at that point were 49% above the 5-year average. In addition, we were about to embark on a great increase in production due to fracking. In fact, we were anticipating the largest percent increase in history that year. But as I'm going to share with you in a minute, the price of natural gas in 2012 approached $4 by the end of the year. Now let me give you a comparison to this year. We anticipated we're going to end the winter heating season in a couple of weeks about 18% above the 5-year average. This is a little higher than I estimated last month. I believe it was going to be about 8%, but still 18% is far less than the 49% above the 5-year average we saw in 2012. Also, in 2012, we saw an explosion in production due to fracking, and prices still approached $4 by the end of the year. But this year, we're anticipating that production is actually going to decrease this year. One might have argued in the spring of 2012 that although prices were very low, they would not increase substantially due to the production increases anticipated in 2012 from fracking. But as you can see in this chart, prices sharply increased after trading below $2. Anyone who hesitated to lock in the low rates early in 2012 paid dearly by the end of the year. There are times when a commodity must increase simply because it is just too darn low. Therefore, since natural gas prices are the lowest they've been since we began trading in 1990, and production is anticipated to decline this year, not increase like we saw in 2012, and we're going to end the winter heating season with much less supplies than we saw in 2012 when supplies were 49% above the 5-year average. Where do you believe prices are likely to go by the end of the year? There's great uncertainty about what lies ahead. But I do believe pricing is going to go higher. And if you're not already locked in with today's low rates, I recommend you do so as soon as possible. I hope you found today's video helpful. And until next time, take care.